What's up everybody, Genix Dividend Investor here. In this episode, I'll show you how I make $150,000 per year in passive income from dividends. I'll start with a look at my portfolio in Fidelity, then share some interesting dividend charts from my spreadsheet tool, and finally explain some of the strategies I use when analyzing covered call ETFs, including why some of them strike me as feeling like Ponzi schemes. Feel free to use the timestamps if you want to jump ahead to my tickers and income, but I recommend you don't. And I apologize if my last few videos had bad audio. I just figured out that a recent Windows update I applied apparently changed my audio settings, which borked things up, so hopefully this sounds better now. Anyway, whenever I do portfolio updates like this, I pause because I know that some people can get envious when they see numbers they feel are out of reach. But I share these updates because I hope they inspire others, and because investing has been one of the smartest financial decisions I've ever made. I truly believe that almost anyone can build a solid portfolio given enough time. That being said, most people feel behind the 8 ball when it comes to their retirement. Like today I saw this article about a 50-year-old who has $60,000 saved for retirement, which is well below where he hoped he'd be. But according to Vanguard data from last year on median retirement savings, that $60K actually puts him right at the median for his age range. He and I are both in the 45 to 54 bucket, where the median retirement savings is $60,000. The main reason I'm ahead of the median is because I started investing as soon as I graduated college and got a job, and have kept investing for over 3 decades through all market conditions. And if I ever got a bonus at work, my first thought was to invest it rather than spend it. If I sold my house, I'd put 20% down on the next one and then invest the rest. That steady focus on investing over time is what got me to where I am today, but don't stress out if you're not where you want to be yet. The great news is that you're watching financial videos like mine, which will help improve your financial literacy regardless of how you choose to invest. And the last thing I want to mention before showing you my Fidelity portfolio is something I might not have made clear enough in my last video, which is why I want to generate more passive income now, even if it comes at the cost of growth. This shift is driven by a few changes in my life, including that I'm seeing my living expenses rise faster than expected, I'm facing more health issues and higher medical costs than I had planned for, and I'm feeling a stronger need to support my relatives financially. On top of that, my recent health episode has made me want to take more vacations with my family to truly celebrate whatever time I have left on this earth. And add to that a desire to move a bit more into ETFs so my wife and future generations can manage things a bit more easily when I'm not around, while also wanting to lock in some gains on certain stocks to reduce risk and better match the stage I'm at in retirement. Ultimately, I realized my portfolio was tilted too much toward growth for my current retirement needs and my dividend-focused investment strategy, which blends some growth with quality sustainable income. My reality is that I now face a greater chance of slipping into a vegetative state, or worse, and there's no way to know how long that might last. And the longer I'm gone, the more important it becomes to have more reliable passive income flowing in to help my family manage that difficult reality. So this shift helps me to benefit more from my portfolio now while I'm still alive and clear-headed, and still preserve some growth potential for the future when it eventually passes on to my children. Hopefully that makes sense. Anyway, in my previous video I talked about why I was thinking of making some changes and how I plan to do them. Now you'll see how I ended up trimming some of my Apple position while still keeping a decent sized 50K stake in it, along with trimming a few other positions I wanted to reduce in order to free up cash for a new income ETF in GPIQ, Goldman Sachs Nasdaq 100 Premium Income ETF. I decided I'd make this new position about the same size as my JEPQ position to see how they each perform over time, amongst other reasons. Now my income ETFs are a bit under 15% of my portfolio, which I feel is reasonable for a conservative retiree, and I'm happy that those ETFs have multiple assets and management teams and strategies, all of which may help smooth out returns and reduce the impact if one fund underperforms. Okay, let's jump into my Fidelity account now, and then I'll show you some cool dividend charts of my portfolio in my spreadsheet tool, and finally I'll share some of the strategies I use when analyzing covered call ETFs. So I took this screenshot on August 11th after the market closed. Overall, I have $3.46 million of tickers in my Fidelity portfolio. My retirement account is worth $1.49 million, my taxable is at $1.76 million, and my wife's retirement account that I manage is $217K. My portfolio is about 93% domestic stocks, 6% foreign stocks, and a smattering of other stuff. Okay, let's jump into my IRA. Now instead of going over every ticker in every account, I'll just show you screenshots of my tickers and go over the totals, and then I'll go over each ticker in my spreadsheet tool, as that's an easier way to see everything in aggregate. So my IRA is around $1.49 million worth of tickers, and Fidelity estimates that they generate over $68,000 of income each year. Note, I'm under age 59.5, and since I'm withdrawing my dividends early, that means I pay a 10% penalty tax on those distributions. Fortunately, my taxable account is mostly qualified divvies, which have better tax treatment, and I also have some return of capital in it, which means no taxes or reduced taxes for the next few years on specific tickers. You can see it's worth around $1.76 million, and Fidelity estimates that it generates over $73K per year in divvy distributions. Then we come to the rollover retirement account worth $217K, and which yields about $8K in divvies per year. That's a bit over $149K of annual estimated income, and in the next week or two we should see a 4 to 5% dividend hike out of Altria, which should raise my annual dividend income by $750-ish bucks, taking me to a bit over $150K a year of passive income. And then this is something I put together where the top is Fidelity's total return for my portfolio, which is from the time I moved there from E-Trade, which was February of 2021 until now. And you can see that it says my cumulative return is 67.56%. On the bottom is a Seeking Alpha chart I pulled, which shows the total returns of the overall US stock market over the same time period, which was 62%, which means I've outperformed the overall US stock market. But I underperformed the SP 500, which is what I'd expect given how much of the gains in US stocks are from the Magnificent Seven. Still, to be outperforming the overall US market is better than I expected given the environment and my conservative strategy, so I'm happy about that. Now, if the markets crash, then I'd expect my covered call dividend income to decline, whereas I'd bet the majority and maybe all of my single stocks will continue to hold and raise their divvies. But I also expect that as markets recover after a crash, the distributions from my income ETFs would also increase. Anyway, if you're new to my channel, then you might be wondering how I built this portfolio, and the answer is I started from scratch and never inherited anything or was given any money or assets or anything, and instead I'm just an example of what long-term investing and compounding can accomplish. A question I sometimes get is why do I focus on dividend stocks so much, and one reason is because I saw how blue chip divvy stocks held up much better in the dot-com crash and again in the 2008 financial crisis. Plus, as my health issues started piling up, I came to really value truly passive income. I also have multiple close relatives who ran out of money in retirement and are now barely getting by on Social Security. So seeing all that happen was big motivation to invest in good passive income stuff, and I've always loved the idea of getting a share of a company's profits in the form of cash dividends. Now I no longer worry about running out of money in retirement, though 51% of Americans do think that it's somewhat or very likely that they'll run out of money in retirement. Anyway, let's jump into my spreadsheet tool. I have my 29 tickers sorted from largest position to my smallest, and this is page 1 of 3. Up top is Altria, ticker MO, and I have 3,799 shares of it, and it's 7.2% of my overall portfolio, and MO has done way better than I expected and thus moved its way up into the top of my portfolio. I have almost 250 grand of it, and it pays me $3,875 each quarter, which is about $15,500 a year. That's why a 4 or 5% dividend hike will be like another $700-ish bucks a year, taking me a bit over $150K of annual income. Its current yield is 6.2%, and its 3-year dividend CAGR is 4.2%. Next up is Realty Income, and I have almost 218 grand of it, and it pays me $1,020 each month. After that is SCHD, and I have 216 grand of it, and it pays me about $8,200 a year. I'm currently reinvesting about 20% of my SCHD distributions back into itself, like I do for each of my ETFs. After that is Microsoft, and I've got 195 grand of it, and I think it's my best long-term growth driver in my portfolio. My next largest ticker is AbbVie, another strong performer, and I have 185 grand of it, which generates $6,100 a year. After that is J&J, which has been beaten down by all the litigation concerns, and I have 168 grand of it, and it generates about 5 grand of divvies each year. Then is another Sin stock in BTI, which has also been doing crazy well, so it shot up in my portfolio, and now I have 164 grand of it, and it generates a little over 9 grand of divvies per year. Then we come to my 3 income ETFs in DIVO, and my new ticker in Goldman Sachs GPIQ, and then JP Morgan's JEPQ. I have about 150 grand in each, so it'll be fun to see how they evolve from here, and I can say that they've outperformed my expectations so far. Note, I actually also have another smaller income ETF in IDVO, the international version of DIVO, which I'll show you in a moment. And reminder, please don't invest in CC ETFs just because I have some. My recommendation instead is just to go with VU, as most people are probably in a portfolio growth phase, not in a retirement phase like me. And even if you are in retirement, don't copy me. I mean, my risk tolerance is unique to me. Moving on, we come to the next page of my tickers, and we see Enterprise Products Partners, ticker EPD, is up top, and I have almost 150 grand of it. I've been loving how its distributions have been tax-free for me, and should be for multiple years to come, assuming my tax guy is correct. It's an MLP, so I keep it in my taxable to avoid the risk of UBTI. EPD generates about $10,400 of distributions per year for me. Next is Duke Energy, and I have 135 grand of it, and it yields almost $4,600 a year. Then I've got Goldman Sachs, and I have almost 128 grand of it, and it yields $2,840 a year. Then is McDonald's, worth 125 grand, and which yields $2,900 per year. After that is Procter & Gamble, worth 119 grand, and which yields $3,250 a year. Then is Coca-Cola, worth 118 grand, and which yields $3,400 a year. After that is another Sin stock in PM worth 113 grand, and it's yielding almost 3,600 bucks a year. After that is Pepsi, which has been struggling a bit, and I've got 111 grand of it, which yields about 4370 a year. Next is Southern Company worth 106 grand, and which yields 3,300 bucks a year. And the last one on this page of my tickers is Kimberly-Clark worth about 75 grand, and which yields 2,800 bucks a year. Moving on, we see that I have ExxonMobil worth 72 grand, and which generates 2,700 bucks a year. Then Chevron at 56 grand, yielding 2,500 bucks a year. Next, Colgate Palmolive at 56 grand, yielding 1,387 a year. Then my Apple position at 52 grand, yielding 240 bucks a year. Then Caterpillar at 52 grand, yielding 770 bucks a year. Then Travelers worth 41 grand, yielding 680 bucks a year. Then IDVO worth 39 grand, yielding 2,150 a year. Then Home Depot at 39 grand, yielding 920 bucks a year. And finally, my smallest position in Starbucks worth 28 grand, yielding 760 bucks a year. I have 45,700 shares of tickers, and my overall portfolio is worth 3.46 million US dollars that I previously showed you in Fidelity, and as of this moment, my spreadsheet estimates that I make 149,737 bucks, though remember Altria should be dropping any moment. My portfolio's average weighted dividend yield is 4.32%, and its 3-year dividend CAGR is 5.6%. Moving on, we come to this dynamically generated chart which graphs my dividend income by month since I created this new version of my spreadsheet in January of 2020. This month's income in August is still flowing in, which is why it's a short rectangle so far, though I expect to make over 12 grand in divvies this month. Overall, I believe my income will trend upward over time, with occasional periods of flat or declining payouts during major market downturns if covered call income drops significantly. Moving on, we come to this chart which breaks down how much dividend income I should get on average, broken down by year, month, week, etc. Now you might be wondering why this shows my annual income is $149,828 when the last screenshot had it at $149,737, and the answer is because my spreadsheet dynamically updates based on changing currency conditions, which means that as the British pound changes relative to the dollar, then my BTI's position income also changes. So since I took this screenshot a bit later than the previous one, my annual income ended up changing a bit. This shows that my average monthly income is $12,485, my weekly is $2,881, my daily is $410, and my hourly income is $17.10. And that number is actually better than an hourly wage number because my portfolio is working 24 hours a day and through holidays and such. Plus my taxation is better, on average, than wage income, even though some of my divvies are ordinary rather than qualified, and even though some of it is penalized for withdrawing from retirement accounts early. Bottom line, my hourly wage equivalent income is multiple times higher than this average hourly listed one. Okay, moving on, we come to a section of my spreadsheet I call the Dividend Calendar View. It shows the next 6 months of dividend income being paid out by ticker. This is still sorted based on my position size, so MO is up top, and my next payout of it should be in October for $38.75. Of course, I'm confident that MO will announce their dividend hike before that October payout, so I'll probably end up getting over $4,000 a quarter from then on. Below MO is Realty Income, the monthly payer, and this month it'll pay me $1,020, and then in September it'll again pay me $1,020, and every month after that it should keep paying that amount until they hike or suspend or whatever. On the bottom we see the total monthly payouts, so this month I should make $12,180 in divvies, then $14,261 in September, $10,741 in October, $12,431 in November, $14,018 in December, and about 11 grand in January. Moving on, we come to this chart which shows my estimated income over the next decade, with the blue bars being how my divvy income could grow if I'm spending it all, which I'm mostly doing, versus the red bars which are how it would grow faster if I was reinvesting it all. I'm guessing I'll end up between these two estimates since I'm reinvesting a subset of my ETFs back into themselves. You can see on the left that the current income starts at $150K. By year 5, this estimates my income should grow to $200K a year if I keep spending all my divvies rather than reinvesting them due to the increases coming from dividend hikes that it assumes I'll get. Or if I had been reinvesting all my dividends rather than using them for expenses, then this estimates that my income 5 years from now would be around $240K a year. You should visually be able to tell how the red bars of reinvestment grow faster than the blue bars of not reinvesting, which shows how compounding is so important. Moving on, this is my portfolio value by sector. I mark my tech-centric ETFs as tech and my broader sector ETFs as ETF. So you can see that my bigger wedges include tech, SIN, consumer staples, etc. And here's my annual passive income by sector. Okay, now let's move on to talking about covered call ETFs. A good question to ask is whether covered call ETFs are too risky, and the answer requires taking a closer look at how they work and deciding if they align with your own risk tolerance. So at a high level, covered call ETFs are just funds that hold stocks and sell call options on them to generate extra income, while also earning dividends and sometimes profits from selling stocks. Options are just a type of financial contract that gives you the right to buy or sell an asset at a set price within a certain time. Covered call ETFs aim to provide a more consistent income stream than relying solely on capital appreciation, generating returns from both dividends and the premiums earned from selling call options. While those premiums fluctuate with market volatility, they still can offer a regular source of cash flow that is less dependent on stock price gains. One trade-off is that if stock prices rise above the option strike prices, the ETF may have to sell those shares at the agreed-upon price, which can limit potential gains. That's why covered call ETFs are often said to miss some of the market's upside. Some options ETFs use other strategies, such as puts for protection or income, call spreads to shape risk and return, or dynamic option writing that adjusts to market conditions. These choices influence both the income the ETF generates and the amount of upside or downside it experiences. A simple income strategy many investors use is the wheel, which involves selling cash-secured puts to potentially buy a stock at a discount, then selling covered calls on the shares you own to collect additional premiums. If you try it, research it thoroughly, start small, and avoid chasing too much income too quickly. And don't get greedy and don't force it. I used to run the wheel strategy myself, so I know how to do it and that it doesn't take much time. But my health realities have changed my perspective, and now I prefer to outsource that work through certain covered call ETFs. That way my income strategy runs on autopilot, stays consistent without needing my involvement or my family's, and keeps my portfolio simple and manageable for the long term. So the next question you might be asking is, what are the key risks with covered call ETFs? Well, one, like I said, they can cap your upside. I mean, if the underlying stocks rise sharply, you might see underperformance in a strong bull market. 2, they can still fall during downturns because the option income may not fully offset declining prices. 3, payouts can be unpredictable. That variability can be a problem if you're counting on steady income, and there may also be tax implications or liquidity issues with certain funds. 4, some ETFs use unique option strategies or hold unusual underlying assets, so it's important to check those details carefully, along with basics like expense ratios. 5, the way the strategy is executed matters. Things like strike price selection, how often calls are sold, and the percentage of the portfolio covered can make a big difference in results. 6, they can underperform in prolonged market downturns when stock prices remain depressed and income sources such as option premiums and dividends decline. And 7, there's a risk of destructive return of capital, which happens when a fund's value erodes over time while it continues paying high distributions. I'll explain exactly what that means in a moment. Now, a simple thing I like to do is to check whether a covered call ETF's NAV is trending upward. A site that says it has NAV is Charles Schwab, which shows NAV changes over time. For example, here's JEPQ's. It shows JEPQ's 1-year NAV change at 9.8% and a 14.6% annualized change since inception in May of 2022. In general, I like to see a covered calls ETF's NAV at least hold steady and ideally grow over time. That tells me the distributions are probably not eroding the fund's value, though it is important to look at trends over several years and keep market conditions in mind. If the NAV is consistently negative by roughly 3 to 5% a year, then I feel that can be a warning sign of potential destructive ROC. At the same time, it's useful to look at the NAV trend in the context of what the broader market is doing. Like if the S&P 500 is down 10% in a given year, then I'd also expect a covered call ETF that tracks the S&P 500 to see its NAV decline as well. Another thing I've come to see with most covered call ETFs is some long-term NAV erosion. I mean, because the upside is usually capped in bull markets, they tend to miss out on the full market growth, and high distributions can sometimes exceed what the portfolio earns from dividends, option premiums, and capital gains. Because of that, I'm not sure it's realistic to expect the NAV to always grow, but it is important to make sure that the total return, which is the NAV change plus all distributions, still meets your goals. If the NAV is eroding slowly while the income is serving its purpose, that may still be fine for some income-focused investors. It's a bit like the 4% rule, where you gradually draw down principal over time. That can last for many years, but it does come with more risk. However, if the NAV is dropping quickly year after year, or the total return gap compared to its benchmark is far bigger than you would expect, then that could be a sign the payouts are too high to sustain. Destructive return of capital happens when a fund pays out more than it's actually earning and covers the shortfall by selling assets or borrowing money. That's basically giving you back some of your own money, which reduces the fund's ability to make income in the future. It's not illegal, but it can feel a bit like a legalized version of a Ponzi scheme. I mean, in a Ponzi scheme, a scammer promises huge returns, like 15 or 20% a year, but the money paid to investors doesn't come from real profits, it comes from new investor contributions. Early investors may walk away with big gains, making the scam look legitimate, but over time most people lose because the returns were never real. With a destructive return of capital, it's not exactly the same, but part of what looks like income is really just your own capital being handed back to you, slowly eroding the investment's base. One way I like to check if return of capital is non-destructive is by reviewing the fund's annual and semi-annual reports along with its Section 19A notices. I like to see if the total income from options, dividends, and realized gains consistently meets or exceeds the total distributions over time. If it does, then I believe those payouts are backed by real earnings. If it doesn't, and a big portion is marked as return of capital year after year, then that's a strong sign that payouts are destructive. Also realize that a fund can still show a positive NAV trend and a positive total return since inception while paying out some destructive ROC. This can happen if the underlying assets grow enough to offset the erosion from those payouts, i.e. stock appreciation can hide the damage for a while. So if the fund earns less than it distributes in a given year, part of that distribution is a destructive return of capital. However, if the portfolio's stocks rise in value enough, the NAV can still increase despite their erosion. Over several years, market gains can outpace the damage, creating the appearance of healthy growth even while destructive payouts occur. That's why the NAV trend alone is not definitive proof, even though a positive NAV return since inception is a strong sign that a fund's total earnings have outpaced its distributions, resulting in a net increase in portfolio value. In most cases, this suggests any ROC in the distributions is a tax-efficient accounting choice rather than evidence of the fund depleting its principal. Anyway, beyond NAV, you also want to check the total return for a covered call ETF, and I like to use Seeking Alpha's momentum chart for that. I'm an affiliate of Seeking Alpha because I think it's a valuable website for serious investors, and my link is in the description of this video. Okay, let's check JEPQ as an example. Here we see JEPQ's total return since inception is at 55.6%, slightly under the SP 500s. Hopefully now you can understand why I like to see non-destructive ROC. It usually means the managers are skilled at running their options strategy, and they're generating enough cash to cover distributions, along with the dividends they collect and maybe some gains from stock sales. I recommend watching my last video for more on the risks of covered call ETFs that you should know before investing, including the fact that your income can drop a lot during market crashes. And speaking of crashes, here's my question for you. Do you think we'll officially go into a recession in the US within the next 12 months? I'd love to hear your guesses and any reasons behind them. And with that, I ask that if you appreciate me doing this video, then please show your support by hitting that thumbs up button, subscribe if you haven't yet, and click that bell notification, as all of that really helps my channel. Now I'd like to shout out my newest Patreon aristocrat, so thank you La Cacatiello for signing up. Next I'm going to shout out my Gold Star channel members, i.e. the ones that have been members for 12 months or more. So thank you Brett Cherry, Aaron, Scott Goodwin, Steve Doxa, and Keithman 5000. Moving on, now I'd like to show my gratitude to subscribers who've left me really kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Magnus Listberg 687, Shane A 9613, John B Bidwell, Clownin' Around 7996, who's left dozens of nice comments, Dragoon 1269 MN, Caddy 1A, Wyatt Abbott 2754, Simply Divvies, Magnus Skulland, and then multiple from Joseph Awad 3493. Thanks folks, I really appreciate it. Now I'd like to recommend that people check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'd also like to pitch my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.